Hello, everyone. Today on the Final Bar, we'll do our normal Friday routine. We wrap the week. We focus on how the markets have evolved from last Friday to this Friday. This week in particular, a lot of catalysts floating around between the Fed, renewed discussion about coronavirus and the evolvement or evolution of the new Delta variant and how the economy may be affected, and tons of earnings. We'll look at all that and more. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. This is Dave Keller here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the evolution of the markets using charts. I was taught early on as I was learning about the financial markets, learning about investing, learning about trends and investor behavior, that the best thing you can do to make sense of things in uncertain times is focus on the charts. And I've used charts through many periods of uncertainty, the whole 9/11 period, the unwinding of the tech bubble, the financial crisis, so many other things between here and 21 years ago. And charts have been a consistent provider of value and especially of awareness, right? If you want to understand what's working and what's not, if you want to answer the questions, where are the trends? How do I follow the trends? And when may the trends be exhausted? Charts, I would argue, are the best way to minimize the impact of negative behavioral biases and focus on the actual evidence, the action of the market participants themselves. The S&P, if you're getting any indication on just today, it's a bit more distribution. You've had stocks that have had, in some cases, decent earnings, in some cases, a little more challenging earnings, but one consistent thesis, I would argue, from this week in particular is a lack of upside follow-through. Stocks like Amazon and others that could have certainly used this as a springboard to higher highs or to push further. You know, a lot of them showed the signs of getting bid up leading up to the announcement, but really not following through to the upside. Whether or not they missed something like Amazon with plenty of negativity in their earnings release, or others that did just fine with their earnings, didn't really have a lot of upside follow through. And a day like today, limping into the weekend as the market distributes a bit, I think is noteworthy. We have great guests on the show. Had a lot of fun this week talking with some of our guests. I enjoyed talking with Bruce Powers yesterday. If you missed that one, it was a pretty good discussion. The couple individual stock ideas next week. More good guests to speak with. We have actually three fantastic guests next week. On Tuesday, the 3rd, we have Andrew Thrasher from Thrasher Analytics. On Wednesday, Sam Stovall from CFRA Research. He really literally wrote the book on sector rotation that I remember reading early on in my career. It'll be a pleasure to talk with him given the rotational environment we've been in. And then Mark Chaikin joining us on Thursday, the 5th. To share with us some of the tools he is using with his customers at Chaikin Analytics. Then coming up the week after that on the 10th, we have Gary Dean from sentimenttiming.com, Samantha Leduc from Leduc Trading joining us on the 11th. A lot of fantastic guests. If you missed any of our previous discussions, which have been really fantastic, go to stockchartstv.com. You can watch all of our previous episodes on demand. Let's get to our Wrap the Week segment. We're going to start with a poll question. We have a poll running pretty much at all times. On our live stream page, if you go to the StockCharts website, click on StockCharts TV at the top to watch our live stream. We'll have a poll there running just on the right side of the screen. We also send them out on social media as well. And recently we asked you, how important is sentiment? Things like the AAII survey, the name exposure index, and others. How important is sentiment in your process? Very important, somewhat important, not very important, or I literally never look at those things. I'm concerned about the 22% that never look at them. And the reason is because I've tended to think of macro analysis in three parts: price, breadth, and sentiment in that priority order. Price is most important. What is happening, the market and the message of the market itself. Breadth tells you a little more. It's sort of like peeking under the hood behind the price, right, or underneath the price. What's actually driving the performance of these indexes or the ETFs that you're looking at. That's why breadth is so important. Sentiment is a third very crucial piece because it talks about contrary opinion. And if you haven't read about contrary opinion, dig up Humphrey Neal's book on, I think it's The Art of Contrary Opinion, if I remember right, or The Art of Contrary Investing, something like that. But look for Humphrey Neal and Contrary, and you'll find this book. But he talks a lot about keeping a media notebook and looking at headlines and looking at newspapers and magazines. And obviously now we have so much more opportunity to identify, contrary opinion. When are investors too bullish or too bearish? Most of you put it in the somewhat important or a very important range, and I think that's a pretty good spot to be. I think that's where I would definitely put my vote in. Somewhat important. It's not the most important. And if I had one thing to look at, it would not be a sentiment indicator. But I have found them to be really helpful. And I'll tell you where it's most helpful is showing you is helping you understand what charts you should look at. When you see sentiment spike, it makes you think, all right, what stocks are actually moving? What's causing this appreciation? What are investors trying to do? And what thesis are they trying to express in their holdings? And so that's why I would encourage you to check out some of the sentiment data that we have on stockcharts.com. Continuing on with our Wrap the Week segment, here's how we normally do it. We'll just briefly talk about the markets today and talk about how Friday played out. We'll quickly go through the Wrap the Week chart that we review, which looks at an asset allocation performance chart over the last 5 trading days. And then we'll finish off looking at the Mindful Investor live chart list, look for some key themes in price, breadth, and sentiment. Let's get to it. So today, certainly distribution mode. You had negative earnings yesterday with Amazon after the close. As we were recording this show, you saw the beginning of the distributions there, and giving a little more chance to read up on the earnings report and look at the reaction. Certainly following through to the downside, Amazon back below its 50-day moving average. Big mega cap name like that, like Apple, like others that instead of breaking out of their bases and continuing, they've broken out of bases and now coming right back down to earth, which for me, it feels anecdotally very much like an exhaustion gap, right? Sort of like that last big gasp to the upside before something happens. Having said that, as long as the market continues higher, the market continues higher. Today was down 0.5%. We'd have to go a lot more further down before we reach the 50-day moving average. Currently around 3 to 3.5%, I think, below current levels, if I remember right, probably 3.5% below where we're at. So that's not too far away. That's a couple down days away, but it's certainly the line in the sand so far year to date. Mid caps and small caps down just a little bit. They were up earlier in the day, but finished in the red, and the VIXs are just above 18 now. Interest rates actually weakening today, coming off as bond prices bouncing higher. The TLT was up about 0.5%, and the dollar index, which has been coming off recently, bouncing a little bit higher, about 0.25% to the upside. Gold really spent most of the day in a downtrend. It bounced a little bit in the last hour, but most of that was negative, with gold down about 0.8% by the end of the day. Mixed results from the rest, although net negative for commodities. Energy, oil prices up a little bit, but energy stocks got beaten down. You had Exxon and Chevron both reporting earnings before the open today, and both finishing in the red. Cryptocurrencies continue to be quite volatile. They're spiking here as we're recording the show, but I think for Bitcoin, you're looking at that 40,000 level, which has been a bit of a magnet price for the crypto for the last couple of days here for much of this week. So I'd certainly pay attention to see what happens over the weekend if it's able to get above 40,000 and remain there. In terms of sectors, very quickly, you had materials number 1 and real estate number 2. Pretty much everything else was flat to down, and the biggest weights consumer discretionary down 2+%, energy, utilities. So certainly a defensive feel to the top of the list. Besides materials, it's REITs, consumer staples, and then healthcare and technology in the middle there. You get some things that are sort of a mix, but probably thought of more as offense than defense. Let's look at the weekly wrap chart. That's this one right here. That is not it. Here we go. Let's refresh the chart here for the close. We're starting the clock last Friday at the close and just looking at the movements of each of these asset classes using ETFs, and I'll walk through them very quickly and identify each of these lines. The S&P 500 is here right in the middle in black, down 1/3% for the week. Underperforming stocks for this week, we have the dollar index using the UUP down 0.8%. Down 1% was the NASDAQ 100. We're using the Qs for that. And then in orange, this is emerging markets down 1.7%. Boy, EM has really been pretty weak. And this week in particular certainly saw further distribution relative to developed markets. What outperformed US stocks and overall finished the week in the positive, you have a cluster of things right here, right around 0.7 to 0.8%. In red, we have the TLT, that's bond prices. In purple, we have small cap stocks. And then this is gold here in the very appropriate gold color. The strongest of the bunch up here at the top is crude oil prices using the USO, which was up 2.4%. Now, when we add Bitcoin to the mix, you can see Bitcoin was actually the big gainer of the week, up 18.6% for the week. So, cryptos as usual skew the distribution of most things. I'm actually going on a podcast next week, I think on Tuesday or Wednesday, to talk in particular about cryptocurrencies and some of the technical considerations, behavioral considerations, and how to approach trading cryptocurrencies. And one of the things we'll talk about is just the elevated volatility, the pure speculation that I would argue is running rampant. That's not by definition a bad thing. It's just certainly something to be aware of when people are not necessarily grounded in fundamental data and long-term investing, planning to retire on Bitcoin necessarily, but it's more, it's more speculation. It's more, it can be more quicker money and more, certainly more volatile. And the evidence has absolutely supported that. So Bitcoin up the most out of all the ETFs that we addressed this week. Let's go to the Mindful Investor live chart list. This is the chart list that I maintain at all times on StockCharts. At all times is probably not correct. Maybe about once a week, I'll make sure that this is updated really in preparation for this show. I'll make sure all the charts are updated, but this is a list of charts. This is a great process if you just want to get a sense of price, breadth, sentiment, and then a bunch of key ratios, which helps you understand the relationships between different themes and groups and asset classes and styles. I would recommend taking a look at this list with some regularity. To get to this, by the way, if you've never looked at it before, go to your dashboard. Actually, that's not true. Go to the articles page, which is where we have all of our blogs. Mine is called The Mindful Investor, which is this one here. There's this gray button right at the top that says Live Chart List. That'll get you to this page, which we will review together now. First one is the market trend model. This is a weekly model that we update every Friday at the close. It's a way to track medium-term, long-term, and short-term trends, and just have a model running in the background. I do very little on an automated basis, although I do some things based on a momentum model, but most of my stuff, the model is not an output of the process, but it's more an input of the process, into the process. I like having something like this running just to have a systematic way of determining what are the three trends on the timeframes that I'm interested in, and use that to compare it to what I'm seeing on the charts. Because a lot of times this will help keep me in things I would normally maybe get nervous about, or help me to remain cautious when I might get excited based on what I'm seeing on individual charts. What is the model telling us? So it's the long-term model, which is really a secular trend, has been positive since June of 2020. Nothing is going to change on that model until we get quite a bit of distribution. It's been positive and remains so, which is absolutely fair given the strength in the long-term trend. The medium-term trend model for me, which is literally based on the weekly PPO, turned negative in mid-May and has remained negative. And even with the S&P going to new highs June into July, it's come really, really close. And you can see on the histogram, it's just a hair below zero, but it just keeps not going positive. And what that's told me, and what I've encouraged my clients how to think about it, is just it tells me to remain cautious. For me, the medium-term model is not a systematic risk on, risk off. It's more telling me whether to think more about potential reward or potential risk. And when it's on a sell signal, it tells me to be thinking more about the risk side of things, to make sure that stops are updated, to make sure you have clear lines in the sand to define downside risk and protect from climactic capital loss, which I think is one of the best things you can do as a long-term investor. So it has remained negative. It remains negative on the close today. So overall, telling me to remain cautious. And arguably, I would say that the market has been in a correction mode since April. It's just been a stealth correction. It's not an obvious price correction. It's more a stealth correction. I can show you plenty of charts that have really deteriorated since April to May. And I think that's the real story here right now. Short-term model remains positive, and that's simply looking at where we're at relative to the 5-week exponential moving average. The daily chart of the S&P, we actually had a question on this, which I'll save for our mailbag segment after the break. But overall, here's what I'm seeing. I think the S&P chart is easy, if a chart ever is easy, only because the 50-day moving average has kept you in this long trade, especially year to date. That has been the game. Buy when it pulls back to the 50-day, it continues to revert higher. I'm going to assume that pattern continues. The 50-day moving average, if we would distribute next week, is right 3.5%-ish below where we're at. We go a little bit further than that, 4.5% to 5%, I think puts us down at the June low. So overall, I think we pull back to those levels. That would be the garden variety pullback that we've seen in the markets so far year to date. I think when something more than that happens, that's when things could really get interesting, because that's when you really have to start thinking about downside protection and hedging and taking bets off and raising cash. At this point, it's more tactical moves within an uptrend that persists, higher highs, higher lows. As long as the highs and the lows keep getting higher, we're in an uptrend, which means I would be eyeing the 50-day. I'd be eyeing this low from mid-July. The bearish divergence is very, very telling. Very quickly, just to update on some other things, I think breadth remains fairly negative. If you look, the cumulative advanced decline lines, even with the strength we had midweek this week, still overall remaining positive. They're in a downtrend, which tells you that the trends are deteriorating. One of my guests this week, and I forget who it was, and I apologize for that, but I think it was on Wednesday's show, someone actually highlighted the increase in new lows, and I think that was a really good way to do it. I have the new lows very, very low only because the new highs are skewing it. But if you look, there have been a handful of stocks on the New York Stock Exchange making new 52-week lows. And this week, it's been more like a couple handfuls. And the more that increases, that tells you that plenty of stocks are actually breaking down in a pretty big way to get down to, a new 52-week low. For a lot of stocks, that's a far way off, but certain names are actually getting down to it. Final thing I would say is that less than 60% of S&P members above their 50-day moving average. It's not yet updated for today. So I'd keep an eye on it going into later this evening into the weekend. But overall, I would say breadth conditions are more in correction mode than uptrend mode. The only thing that's not correcting is the price of the major indexes. And I know I'm saying that with a little bit of sarcasm. Overall, if you're an allocator, I don't disagree with allocating to stocks in a big way, given the trends and given the persistence of those trends. I do have a problem with blindly buying stocks at this point because I think not everything is in good shape. And I think it's a good time to be a stock picker if there ever is a good time to do so. We need to take a quick break. We'll come back and answer some of your questions from the Final Bar Mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close for our show. A couple quick announcements before we get to the mailbag. First off, send your questions to us. We do this mailbag segment twice a week. We've gotten so many great questions from many of our viewers over this time we've been doing the show, and we'd love to hear from you. Answer one of your questions. Anything about technical indicators, particular charts that you're looking at, whatever it is, shoot it to us, send a screenshot or share the chart if you can. That'll help us answer your question effectively. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Just put a comment below the video that you're watching. We would love to hear from you and love to answer one of your questions in our next mailbag segment on Tuesday's show. Also, go to stockchartstv.com, use your email address, set up a free account. You can start watching all of our fantastic content. Many of our wonderful shows, our fantastic guest special events like The Pitch and Charting the Second Half, what we've done in recent weeks. Really, really well done. And a lot of interesting content to help nudge your thinking. Go to stockchartstv.com to get access to our on-demand platform. Also, we're on all the app stores. Just search for StockCharts TV on demand. Let's continue on the show today with our mailbag segment, the Final Bar Mailbag, to answer your questions from your own process of analyzing charts. Here's question number 1. When stochastics rises above 80, is that bullish or bearish? Conventional answers seem to be the latter, meaning bearish, but I've often seen stochastics stay above 80 for weeks and the stocks to rise dramatically in tandem. Any advice on how to read this indicator better than I am currently doing? Really good question. So I have Caterpillar up. I had it up here earlier, and I didn't mention this during the market recap. I meant to. I think this is a fascinating chart. I didn't make it one of the 3 and 3 today, but if I had 4, I would have made this the 4th one. I think this tells the story, by the way, of the rotation from bull phase to bear phase for cyclicals. It's testing its 200-day moving average. It's bounced off of that a couple times in the last 2 weeks. I would look to see if it follows through on that. What's interesting right now is you're also getting a bullish momentum divergence, which is pretty unusual right now. You have lower lows in price, higher lows in RSI. So I think which way this stock breaks, does it go the bullish divergence route, break back above the 50-day, or does it break below the lows and break below the 200-day moving average? I think that's a key chart to watch. But having brought that up, let's switch to stochastics, which I will do here, full stochastics, and I will do this. All right, so to be honest with you, there are a couple different versions of stochastics actually, and we don't have time to go through all of it, but the general concepts of stochastics is this. It looks back over a certain period, let's say it's a 14-day period, which is what this is doing here, and it basically says, let me look at where we're at right now versus the highest high and the lowest low for the last 14 trading days or 11 trading days, whatever you have as that first number. That's what the %K line is basically telling you, is where we're at relative to the highest high and lowest low over that period. So where are we at right now versus the range we've been in for the last X trading days. So if the stochastic indicator, that first line, is above 80, that tells you we're 80% plus of that range over the last X trading days. If it's below 20, we're in the lowest 20% of the trading range for the last X days. Now, these other numbers, the 3 and the percentile line, you basically take moving averages of that first indication. That's the first measurement. And then the different stochastics versions, like the ones I'm showing here, are just smoothing that out. So you have a 3-day moving average, which is the black line. Then you take a 3-day moving average of the black line, that's the red line, and you look at when they cross above and below one another. So the different ways you mess around with this are based on that initial assessment of where we're at relative to the range over X number of days. So the question is that good or bad to be in the upper end of that trading range? And here's the thing, it depends. It depends on your time frame. What I always tell people is the market moves in different time frames, right? So if you're a swing trader, I would use something like a fast stochastics. I think that would be a decent way of looking at when we are in mean reversion mode. So if you've had a big move higher, and the stochastics goes above 80, wait for it to come back down. That tells you that we've hit a short-term top, and now we're rotating back lower. When we do rotate lower, you look for the stochastics to go below 20 and then hook back higher, and that tells you we're at a potentially bouncing point and rotating back to the upside. And in general, if you look at the average chart, and again, it depends on what settings you use and how you particularly want to execute it, but overall, it's meant to identify where we're at relative to that short-term range, kind of like using like a 3-day RSI. It'll look very similar to the stochastics in a lot of ways, calculated differently, but a similar idea, looking at price momentum. But if you're a longer-term investor, the fact that the stochastics get above 80, especially the slowed version of that, I would argue is more constructive, right? Look at what's happened since Caterpillar has moved from an uptrend to what I would call a downtrend, right? If you look back here, the first half of the year, you can see most of the time, much of the time, it was spent with a stochastics above 80. That actually shows you that on the acceleration to the upside, we're getting up pretty good, right? We're trading higher, we're making new highs. That's encouraging. If you look at what happens when we take the last 2 months or so, we've not even gotten near that 80 level. We've actually spent time below the 20 level, which we hadn't touched since January, was the last major pullback in the stock. Now we're not getting above 50 or 60. And so this is actually how I use RSI, is looking at the range of the RSI and how it fluctuates up and down. So I would say on its own, the stochastics being very high is not by definition good or bad. It depends on what you're trying to understand, what you're trying to do. If you're a swing trader, I would say it's a short-term bearish indication, an indication of short-term overbought conditions. If you're a long-term investor, that might actually be a good thing. Maybe tell you to wait a little bit and buy in on the next dip before the run to the next swing high. Next question, you showed UPS and FedEx both having momentum in the oversold range. Is it an indication that Amazon, which depends on online sales, is going down? That was an intriguing question for me today. That's actually a really interesting question. So what you're saying is we have the companies that deliver for the Amazon here, UPS and FedEx. I don't know about you, but usually it's UPS that is at my house way too often during the normal course of business. And the charts of UPS and FedEx have certainly been struggling, right? They've both been breaking down through swing lows. I think that chart of UPS is concerning. It's gone from bullish phase to bearish phase. I would argue getting oversold in my book is not a great thing. That tells you that we've gone down a lot. It doesn't mean we can't keep going lower. Be interesting to see if you get a bounce here, a tradable bounce, and where we go next. And I think the next high, is it a lower high? I think that would be key. What I'd love to say, that was a great indication of problems in Amazon. I don't know if I could draw that conclusion that directly, only because Amazon has a lot of things going on. And if Amazon was in the book selling business purely, I could say maybe, yes, these are the companies that distribute their books for them, but Amazon has a lot of things. You're looking at cloud computing, AWS, and all the other things that Amazon is now into. So I don't know if we could necessarily draw that direct conclusion, but I would say the fact that Amazon has now a failed breakout, a 10-month base, almost a 12-month base now that has failed, and we're back down in that range, is very, very concerning in terms of the overall market strength. Next question, which may be our final one, the S&P 500, is the trend line from the March lows no longer valid, or is the S&P testing it from below? Are trend line tests from below a valid thing? You know, that's my fault. I kind of got away from that trend line, and I'll tell you why. I think of trend lines as pretty far down my list of trading tools. I rarely trade things, and early in my career, I spent a lot more time thinking of trend lines as a really good execution point. I would spend a lot of time trying to measure things and all of that. You know, I've gotten away from that, and I think you know, for me, trend lines are a visual tool. It is a way to visually indicate or represent the pace of a trend. And I'm very interested when the price gets far away from the trend line to the upside, because it tells you that the trend is changing, right? We're accelerating, we're changing the pace of the trend, or when we break the trend line. But I've learned to focus much more on moving averages, on support and resistance, because those are the levels that I think are more important. And the reason is because trend lines are very, very subjective, right? There is no specific way, although there are plenty of rules that Edwards and McGee, who really wrote the classic text on trend lines, I would argue, you know, earlier in the mid 20th century, they wrote a book talking about how to analyze trends and price patterns. And, you know, there are a lot of rules that were involved on how to do them and everything. You know, so there are rules to follow, and in general, connecting the lows are very important. For me, what I've seen is this trend line is no longer a beautiful indication of this trend. For a while, it really was. It felt like in May and in June, boy, this is a really good way of indicating this trend. We've now had a failed breakdown. We're now kind of chopping around it, which is where we've been for the last month or so. Is the trend line still valid? Absolutely. I still have it on my chart. I'm still paying attention to where we're at with it. In general, I'd feel much better about the uptrend if we were above this line than below that line. That is totally fair. But in terms of a signal that would tell me this trend is now broken, I'm thinking the 50-day has become, at least in terms of the data this year to date, has been a much better measure of how this trend is persisting. And that, I think, is the line in the sand for me, much more than that trend line. Your question on testing trend lines from below, absolutely. And a classic move is you have the trend line, you break below it, you test it from below, and then that's the next leg lower. So something to watch for on some of these charts, even like Caterpillar, to be honest, that had that particular pattern. That's it for the mailbag. We need to wrap the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is PayPal. Again, I keep throwing charts that I think are really important to watch, and I think that's the game here. You know, you have this environment with Apple, you know, breaking out and now coming back down, Amazon breaking out, coming back down, Facebook breaking out and coming back down. We have things like Caterpillar that are right at key support, and the question is, does that hold, or do we break the 200-day moving average? I would put PayPal in that mix of really compelling charts to watch. PayPal has now hit its February high. It has retested it a couple times in July, and now after earnings this week, rotating back to the downside. This was one of the stocks that came up in the pitch earlier this week. I would absolutely encourage you to check out that one earlier on our YouTube channel or on StockCharts TV on demand. It was a great conversation. You'll hear why some of the payment processors overall setting up well in the long term, but in the short term, feeling some pain. I'd look to see if it's able to eclipse those highs or not. Chart number 2, I pounded the table on real estate, I think plenty, and I think it was one of our 3 and 3 yesterday, the XLRE. Today we'll highlight healthcare. When I'm screening for individual stock ideas, screening for stocks making new swing highs and new swing lows this week, it ended up focusing in 2 particular sectors: a lot of technology and a lot of healthcare. Particular things like supplies and equipment are tending to test pretty well using our scooter rankings. The XLV is really starting to emerge with some relative strength. It's just making a new 6-month relative high today on the close. That's making a new all-time high for the XLV. I think this is absolutely a sector to watch. I think there could be plenty of further upside in that space. Our last chart today, as I mentioned, 2 of those groups that are scoring pretty well: equipment and supplies. We're highlighting the medical supplies index as one of our industry indexes. Look at this beautiful base: February, April, May, June, July, finally broken out and following through to the upside. This is a group that is a little overbought, but overall, I think the trends are positive. Dexcom, by the way, DXCM, which was the biggest gainer in our large cap space today in that group. Folks, that is our show for today. That's a wrap for this week on the Final Bar. Thanks so much for joining us. As a reminder, go to StockCharts TV on demand on all your mobile devices to watch all of our previous episodes and our great interviews. A lot of great, hopeful market wisdom using charts. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.